When people hear the word trust, their mind usually goes straight to taxes or maybe to their relationship. Kidding. And that's understandable. There are tax strategies that use trusts, but that's not what most revocable trusts are about. At its core, a revocable trust is about organization and control. It's a way to say, if I'm not here, or if I'm here but unable to make decisions, here's how things continue. That's the real purpose. Now, taxes do come into play in estate planning, usually around estate taxes. But estate taxes are completely different than federal income taxes or capital gains taxes. And that's an important distinction. Estate tax policy applies to very large estates, and it's designed to tax wealth transfers above a certain threshold. So, really, an estate tax is a tax on the value of your estate at death. For very large estates, for example, under current federal law, the exemption is roughly 15 million per person in 2026. What that means is if your estate value is under 15 million as an individual, you are exempted from the estate tax. And it's roughly double that for a married couple with proper planning. So 30 million. And that number adjusts over time and is subject to change with legislation. Does not mean it keeps going up. It can absolutely go back down. And historically, the exemption has been much lower. For example, in 2001, it was $675,000. In 2009, it was 3.5 million. So you can see there might be different planning needs depending on where the exemption sits, because it has moved dramatically over time. So yes, estate taxes matter, but just at a higher level of wealth. For most families, a revocable trust is about organization and transition. And today, I want to clearly explain what a trust actually is, what it does not do, and when someone might consider thinking of one. So, what is a trust? A trust is not an account, it's not an investment, it's not something sitting at a bank. A trust is simply a legal document, a stack of papers. That's it. It's a legal document that you might keep in your safe or with an attorney or stored somewhere securely. And inside that document are instructions about the assets you own. And those instructions answer three basic questions: who is in charge? What are they allowed to do? And who benefits from the assets and when? And you might be thinking, well, what does that mean? Well, let's get into it, because there are three roles inside every trust. Role number one is you creating it, legally called the grantor. And then you have the trustee, which is the person responsible for managing the assets according to the instructions. So this is a human being, or it could potentially be an institution that is someone you trust to manage the assets, to manage the instructions for the assets, should you not be able to. And number three, as it relates to that third question of who benefits from the assets and when, which is what we call beneficiaries. Now, here's the part that might clear up some confusion. If you're alive and capable, you are usually your own trustee. So you manage the trust, you create the trust and you manage it while you're still alive and capable of doing so. Nothing really changes in your day-to-day life other than having this trust document. The trust is not necessarily some separate machine running in the background. It's a structure that becomes active when something changes. And I want to show you what a trust document looks like. Now, this is completely fictional, but I think it's helpful to see what a trust document is, what it looks like, what it involves, what it includes. So let's look at one. So here's what a revocable living trust actually looks like. Now, this is not my real living trust. This is totally fictional. It's a sample. There's fake names, fake addresses, but I wanted to at least show you what a document looks like. Of course, right on top, it states the Nick George Revocable Living Trust. I, Nick George, the grantor, that's me. I created the trust of Columbus, Ohio. Now let's look at part two, trust property. The main thing that it states here is it states that the grantor, myself, will immediately connect the assets listed in Schedule A. The assets that are listed in Schedule A need to be connected either by retitling or beneficiary designations. Part three is the purpose of the trust. There's really just two bullet points here, right? The purpose of this trust is to manage and control the assets and property of the grantor, distribute the assets and property of the grantor upon the grantor's death. Boom, that's it. Notice that you don't see reduce income taxes, right? This is much more. Trusts are just about structure, control, continuity for the beneficiaries. Part 4, funding of the trust or funding of trust. Going back to the connection of the assets, the trust must be funded or connected to assets. Part 5, really the wording here is basically stating that I reserve the right to revoke or amend, but upon my death, this trust document becomes irrevocable. This just really confirms it's revocable, right? While I'm alive, it can be changed. At death, it locks in. That's when it becomes irrevocable. Part 6 is about the trustee. So, as I mentioned earlier, I'm alive. I'm capable of managing the trust while I'm alive. So, the initial trustee will be myself. So, I'm playing two roles, the grantor and the trustee. Now, I want to list a successor trustee in the event of my death or incapacity. So, um, the successor trustee I named is my good friend Christopher Columbus, right? And I also named a successor to the successor trustee, right? A backup successor trustee, my other good friend John Smith. So for whatever reason, Christopher Columbus could actually decline being the trustee in terms of unwilling to serve, or maybe he's just unable to. So then John Smith becomes the trustee. This names who's in charge, right? While alive and capable, who's in charge when not alive and capable. That's the continuity. Trustees' powers. So these pages outline what the trustee is just legally allowed to do. It's quite a bit. This really gives the successor trustee real authority to act. And there's just a lot here. They have a lot on their plate. So there's just a lot of legal stuff you got to deal with. And that's why there's most of the time inside of a trust, there's language that allows the trustee to pay themselves out of the trust property. Death of grantor, this is the triggering event. After debts and obligations are resolved, distribution follows the instructions of the trust. Then it discusses beneficiaries, right? That third party or that third role is who benefits from the assets or the trust property inside of the trust. And this outlines how remaining trust property is divided, who receives it, how it's divided, and what happens if someone does not survive the grantor. Part 12 is going to be actually a pet trust type of provision where it's really you can actually direct funds for pets. So I have a golden doodle. His name is Ollie, and I, mentioned to the successor trustee that in the event of my death, please set aside $3,000 out of the trust property to take care of little Ollie and my golden doodle. This is how customizable this document can be. So then you get into schedules. So Schedule A is the trust property, the assets that need to be connected. This is what's actually inside of the trust. So real property, real estate, right? That's actually my primary home. Not in real life, it's a fake address. But underneath that would be a brokerage account held at Clearmine Capital, all checking, savings, and money market accounts, all tangible personal property, my membership interest in Clearmine Capital, and the investment property at 1234 Buckeye Lake Drive, fake address. If these are properly titled, the successor trustee can step in and manage them privately without going through probate. So this transfers to my beneficiaries without going through probate. It's non-public. It's clean and simple. Now, who are the beneficiaries? Well, I made up two kids. These are not my real children. We have little Billy and little Nikki, each receiving 50%. And this is really the final distribution instruction. After everything is settled, the remaining trust property passes according to these percentages. And there you have it. That is a trust document. That's what it looks like. Words, authority, instructions. You're basically writing a playbook that says, if I can't manage my affairs, here's who steps in, and here's what they're allowed to do, and here's how everything is handled. Now, the primary reason most families use a revocable trust is to avoid probate. You may have heard that term before, but if not, probate is simply just the court process required to transfer assets that are in your individual name when you die. If assets are only in your name and there's not helpful beneficiary designations, well, the court must validate the will, appoint the executor, identify assets, oversee payment of debts. And that process can take months, sometimes longer. Accounts can be temporarily frozen. Real estate sales can be delayed. And the biggest one is that in many states, parts of the probate file become public record. And just having a will does not avoid probate and does not avoid that publicity factor. A will just tells the court how you want probate handled, who gets what. A trust operates differently. Instead of using a will to give instructions to the court, you use a trust to give instructions to a trustee, which is a human being that you choose. And if assets are properly connected to your trust, which we'll get into in a little bit, your successor trustee handles the transition privately. So there's no court appointment, there's no public inventory filing for those assets. That's the main structural difference between a will and a trust. And it's not necessarily about one being better or the other, which many would argue a trust is better. It's about whether you want the transition handled through the court system or through a private trustee that you selected. And that's the fork in the road. A little bit ago, I mentioned when your assets are connected to the trust, and that is called funding the trust. A trust only controls what it's connected to, and this can also be confusing. But there are two primary ways assets get connected to a trust: retitling ownership or naming the trust as a beneficiary. Both work, and this is important because either one can avoid probate at death. And there are nuanced differences of why someone might retitle versus just naming the trust as a beneficiary, but we won't really get into that today. So, retitling is what it sounds like. If you retitle a brokerage account into your revocable trust, the ownership changes from, let's call it John Smith's brokerage account to John Smith, trustee of the John Smith Revocable Living Trust dated 12/1/2025 brokerage account. The trust becomes the legal owner. And for tax purposes, nothing changes because a revocable trust is a grantor trust. It uses your social security number. There are no compressed trust tax brackets. Capital gains and dividends are taxed exactly the same as before. Now let's use that same example, but instead name the trust as a beneficiary. So John Smith's brokerage account, he would then add what's called a transfer on death beneficiary designation, naming the trust John Smith, trustee of the John Smith Revocable Living Trust dated 12/1/25 as the beneficiary. So if God forbid anything happened to John, the assets would transfer to the trust and the trust would then become legal owner. And you could add a transfer on death beneficiary and name a human being and not the trust, and it would still avoid probate. Really, anything with a beneficiary will avoid probate, which is helpful to know because you can add a transfer on death to a lot of things, even a house, brokerage accounts. So making sure your beneficiary designations are tidied up, hint, hint, is very important because the asset then transfers directly. So whether you retitle or list the trust as beneficiary, both work in terms of funding the trust or connecting assets to the trust. Now, retirement accounts are handled a little bit differently. They're usually always remained in the individual name. You would not necessarily retitle retirement accounts in the name of a trust or really use the trust as a beneficiary designation. Those are pretty clean and straightforward when it comes to wealth transfers. But a trust might be named, whether it be for minor children, special needs planning. There's a small list of reasons why, but it's not the default. It's also important to make sure that you have a durable power of attorney named. Most complete estate plans include both a trust and a POA. Now, from a high level, there's really two different kinds of trusts. You have a revocable trust and an irrevocable trust. A revocable trust, you create it, you control it, you can change it, you can revoke it. It avoids probate if funded correctly. It does not reduce income taxes. It does not remove assets from your estate. And it does not protect assets from your own creditors during your lifetime because you retain control. An irrevocable trust is different. You transfer assets and give up control. Because control changes, legal treatment can change. Depending on how it's structured, and it can be very complex, but really an irrevocable trust may remove assets from your taxable estate, provide asset protection from creditors, hold life insurance outside of your estate, and really can be used for Medicaid planning. It usually has its own tax identification number, unlike a revocable trust, which would just use your social security number. So it would file its own tax return. And changes are very limited once it's established, and it can get very tricky because you give up control. Different tool, different purpose. And a lot of times when you do pass away, a revocable trust then becomes an irrevocable trust. When should someone consider a trust? Well, this is not about a specific net worth. I mean, you might hear a lot where trusts are only for rich people. Not the case. Not the case at all. It's about structure and complexity. Really a preference call on your end. Some planners argue everyone should have one purely for privacy and probate avoidance. Everyone should have a trust. Other planners might be more selective, but a revocable trust often makes sense when you own real estate or you own property in multiple states. You have minor children. You have a blended family. You want a structured inheritance instead of young kids getting big lump sums when they're 21. You want privacy. You want smoother administration. Situations where it may not be totally necessary is if you just have very simple estate, just not many assets. All accounts, like every account has a clean beneficiary designation. So there are situations where really you could argue that based off of your assets and everything has a beneficiary designation on it, spending the couple $1,000s to create a trust might not be necessary. But again, it's situational. Now, here are just a few common mistakes that can happen when creating a trust. So, mistake number one, you create a trust and never fund it. You never connect assets to the trust. Well, then the trust really isn't a thing then. If assets remain in your individual name or without beneficiary designations, well, then all of that's still going to go through probate. Even if you created a trust, if you don't connect your assets, the court doesn't care that you create a trust. You have to connect the assets. Another mistake is just failing to coordinate all of your assets and your beneficiaries together. Like you might have life insurance, retirement accounts, accounts titled in the trust, TOD accounts, transfer on death accounts. It's important to make sure that everything is coordinated collectively, not just one-offs. And last but not least, choosing the wrong trustee. Being a trustee on a trust is not the most exciting thing, the most fun thing in the world. If you ask a trustee who's gone through that experience, a lot of them say the same thing. They don't like being a trustee. It just takes responsibility, time, and you have to be a fiduciary on the trust. Make sure all the beneficiaries are getting what they are supposed to get, follow the instructions appropriately, go meet with the attorney, so on and so forth. So choosing the right trustee is very important. The document could be perfect, but administration depends on the person you select or the institution you select. So creating the document is always step one, but coordination and titling are where the real planning happens. Estate planning is really decision planning. It's the ability to have control when you are no longer here. It answers who makes financial decisions for you if you can't. How quickly can your family access resources? And what could they access while they wait? How do your assets pass to the people you care about? That's the meat of a trust. A trust is simply an operating system that allows those decisions to continue without court involvement and without delay. You get to literally state how you want things handled in a document. And if you're wondering whether a trust fits your situation, the conversation usually involves a financial planner and an estate planning attorney working together, which the estate planning attorney would then draft the document. Laws differ by state and details definitely matter. I hope this helped clear up that topic a bit. It can be confusing, so it's okay if you don't get it right away, but one quick aside, this is educational information only, not to be disclosure heavy here, but this is not legal or tax advice. Consult an estate planning attorney regarding your specific situation. But thanks for being here. It means a lot. Grateful. Till next time.